Welcome to Bears in Exile. Today is November 10th, and this is the market overview looking at the Dow, SPX, VIX, TNA, UUP, FXE, GLD, and SLV. So today was not as interesting as some of the recent days we've had. We do have some very useful data, and you can make an argument for the bulls or the bears, and I'm still of the bearish persuasion at the moment, although definitely when the bulls pull it out, I am not afraid to say that the bulls have pulled it out. But at the moment, they are not doing it. Of course, we had the big, ugly red bar yesterday. I talked about that pretty extensively. Today, nice green bar. The bulls did try to pull it out today. It was a very valiant effort. You can see that we have a big long tail at the top. They did try for a move on the 200-day moving average, and they backed away from it. Not a great sign. You know, maybe they will try a renewed push tomorrow during Veterans Day when nobody is around and nobody's there to stop them. Then again, maybe nobody who's buying is going to show up. So, kind of a push-pull. We'll see what happens in the morning. We said in last night's video that we needed at least a side tick so that the middle Bollinger Band could complete its move and wind up above the short-term moving averages. That did happen today. We are above all the short-term moving averages. That's great for the bears. Now, obviously, we're going to need some follow-through so that this can be maintained. But for the moment, it is a not a bad setup. So below the 200-day moving average, backed away from it, middle Bollinger Band above the short-term moving averages. The bullish bar is forming, and that is going to need to be overcome before it gets too strong. It has too much depth to it. So looking to see if that happens. What else do we have to look for? Well, downtick on the CCI, downtick on the stochastics, downtick on the RSI, downtick on the MACD, downtick on the histogram, even with a green day. So I definitely believe that the trend is shifting to a bearish one, and the bulls are really going to be playing defensive, and they need to get the ball back if they're going to recapture the initiative. Of course, the 14-day RSI moving average ticking down. So this candle today looks to me like a rear guard action, trying to, fighting withdrawal. But we shall see if that is correct. And there's one other thing of note, which is when you have a giant candlestick, the middle of said candlestick is inherently resistance, as is the top of said candlestick. This works in either direction. And you can see, based upon today's movement, it got right about to the middle of the real body of the candle from yesterday. And that's where it failed. That is completely natural. That is a good sign, actually. So, still of the bearish persuasion. SPX, not nearly as strong as the Dow. We are not nearly as close to the 200-day moving average. Just like the Dow, we have the cross of the middle Bollinger Band above the short-term moving averages. We almost got to the middle of the candle today, but not quite, and it still backed away from it. Notice we do not have as much development in a bullish bar to overcome, and downticks just like the Dow. Oh, which reminds me, silly me, slightly different take on the Dow. We had mentioned in the last video or two that 11,400 was a key number. I'm going to show you why. Okay, volume at price. Taking a look with a visual indicator as to where the buying is occurring. You can see our little run up here, and you can see the major areas of purchasing in the past, which can become resistance as people want to break even. So we have a major confluence of buying it down here, 3 months worth at the 11,400 area. roundabout. So, if there's going to be a floor in the near future, this should be it. And yes, that would take us through the forming bullish bar, but if we do break through it, and it's not very strong yet, 11,400, there should be a pause there, there should be slowdown there, there should be something there. Beyond that, if this were to break, and it should be fairly strong, we also have confluence down here in the 1100 area. You know, we have a nice spot right above it. We have a nice spot essentially just below it, and then just a little bit below that. So two levels, 11,400 and 1100, the area of 1100. So be watching that. We do have these previous levels, which were bested a couple of times over the last 2 weeks, but never bested entirely. You'll notice that we have this major level right here, which was beaten. We have the level just above it that was beaten just a couple of times, but notice that is where it failed. And then the levels that we have above that, they did not reach it. So if we're able to turn around and just fly up, getting through this level will be a major accomplishment, the previous high. But just above the previous high is another level which should provide resistance. So very interesting. Kind of trapped between two levels, and we're waiting to see which one, you know, takes the hit on the chin and falls down. One of them is going to. The VIX. Okay, we have inverse hammer today, which was completely inside the real body of yesterday. You can see that we still have the middle Bollinger Band line below the short-term moving averages. The short-term moving averages are all pointing up, which it should do when the middle Bollinger Band is below them. Now, since this is a potential reversal candle, does that mean that, you know, this is our lower peak and it's going to go down? Does this mean that this journey down is now over and it's going to go higher? Obviously, that is entirely debatable upon which school of thought you belong to. But downtick on the CCI, upticks on the stochastic, uptick on the 14-day RSI moving average, side tick on the RSI, uptick on the histogram, uptick on the MACD. So obviously the majority of the indicators are pointing up. So I would assume that up is the way to go. We will know as soon as if the short-term moving averages are able to completely break through the flatline long-term moving averages. You may see that as early as tomorrow. Of course, we are still above the 200-day moving average, and I've said repeatedly about needing to hold the 200-day moving average by the time the up move was completed. TNA. Oh, also silly me. And of course, we are above the psychologically important $30 mark on the VIX. Very important. TNA. Okay. More of the same. We essentially have a little micro hammer here, which really doesn't mean anything because it's so darn small. And we're just hanging out in the long-term moving averages, which are almost gone. Almost in a flat line. Notice the middle Bollinger Band line is now cleanly above the short-term moving averages. Short-term moving averages are pointing down. We are through the upper price consensus level. Downtick on the CCI, downtick on the stochastics, downtick on the 14-day RSI moving average, downtick on the RSI, downtick with the bearish cross. We did not have that yesterday. Bearish cross on the MACD, downtick on the MACD histogram. UUP. Inverse hammer. Short-term moving averages pointing up, busting through the flatline long-term moving averages. We are holding above the major price consensus level. Slight downtick on the CCI, uptick on the stochastics, uptick on the 14-day RSI moving average, uptick on the RSI, uptick on the MACD histogram, uptick on the MACD. Does look very nice for the dollar. UUP is done. Here I thought I was going to go back to UUP for a second go around. Oh no. FXE. Hammer. Short-term moving averages pointing down. Bearish bar starting to reform. We said we were looking for that middle Bollinger Band above the short-term moving averages, giving it some strength to the downside. Below the major price consensus level, below the previous major price consensus level, piercing but not closing below the current lower price consensus level. Uptick on the CCI, downticks on the stochastics, downtick on the 14-day RSI moving average, very important. Downtick on the RSI, downtick on the MACD, downtick on the histogram. Not looking good for the euro. We said that this is the wish list and not the shopping list, and that we would have to reevaluate and see if it becomes on the shopping list. We did get back into 1.36 on the euro today. Yesterday it was in 1.35. We said that that was our target, and we were expecting overshoot. According to the indicators and the chart, we should get our overshoot shortly. GLD. Okay. Hammer. We had already talked about the downtick on gold. The downtick was resolved today. We do have some crossover in the middle Bollinger Band still into the short-term moving averages, which is fine since we are doing a downtick corrective move that is finished. We are establishing slowly a bullish bar. We're above the upper price consensus level. We need to retest the major price consensus level for the previous month, and I think that we will very shortly. Downtick on the CCI, downtick on the stochastics, uptick on the 14-day RSI moving average, downtick on the RSI, downtick on the histogram, downtick on the MACD. So with the exception of the 14-day RSI moving average, everything is pointing down. And that's okay, because we needed to do that bubble corrective move. And that is accomplished now. Now we can see if it will... it may even go down to the long-term moving averages, and if it's able to bounce off of it, that is very bullish. And perhaps with that kind of a move, we will reset all of the indicators, with the exception of the 14-day RSI moving average, enough that they can turn back up and continue on their merry way. Very nice. And we had hinted at in the last video, does gold go down because people liquidate because they need money to cover whatever positions they have when you have a strong down move like we did yesterday? Certainly today was red, and the dollar was down too, which should give lift to gold, but are people still liquidating to raise cash to cover positions? Very possibly. I do not believe that uncertainty has decreased enough to warrant a significant move down in gold, and I don't think that it is coming anytime soon. But we do get fake NDEs all the time trying to gloss over the euro mess. So hopefully we won't have too many of those, but we definitely should expect some of them. SLV, also a hammer, also inside the long-term moving average is excuse me, I've got a frog in my throat. Short-term moving averages hanging out in the long-term moving averages, collapsing the bearish bar. We are still above the upper price consensus level. We still have a long ways to go to the 200-day moving average and the upper price consensus level. Uptick on the 14-day RSI moving average, although it is losing a little bit of steam. Downtick on the CCI, the stochastics, the RSI, the histogram, and the side tick on the MACD. And I'm still of the opinion that we need to break out, test the 200-day moving average, collapse long-term bar, and hold while the indicators reset. That will be busted, of course, should we already get above the 200-day moving average prior to that time, which will change the game, but we do not want to see a rejection at the long-term moving averages at this moment. We do not want to see them collapse into a flat line and then fail. And that's it. That is the overview for tonight. As always, all investing decisions are your own. This chart and video are for entertainment, educational, and consumption of time purposes only. And good luck. This has been a very difficult market to trade, especially in the last 2 weeks with all of this chop around the 200-day moving average. But I am hopeful that that is about to change. Good night.